Hi, everyone. I'm Rick Bensignor. Today is Tuesday, July 6th, and this is this week's In the No Trader Show. What we've got on tap for you today in our trader education part of the show, we're going to talk about how to handle a cold streak when you're trading. In our market overview, we're going to focus on energy because oil hit a new high today before turning around and selling off. But we got to about almost $77 oil. So we'll take a look at the energy sector via the XLE, the XOP, which is the ETF for oil and gas names, and then we'll take a look at crude oil itself. And in our sector analysis, we'll go through the XOP, the top names in the XOP. So we'll try to get to as many of those names you see here as we can during the 30 minutes we have together. To sign up to get my weekly ETF report that comes out Thursday nights called the Tactical Trader Report, go to inthenotrader.com. It will give you a good globe kind of macro overview of what's going on in the markets. We always look in depth at the S&P, most weeks the bond market, sometimes the dollar, gold, oil, credit spreads, whatever we need to get our points across as far as what's going on in the global macro picture. And then I will give you a new ETF trading idea each week, as well as follow through on every open idea we have from prior week's ETF recommendations until we have closed out the trade. So that again comes out Thursday nights and it's weekly. I also have a monthly report called the 7-Eleven report. And the goal of that report is to beat the return of the S&P. And so far now, through the first 10 months, we started this August 1st of last summer. So we officially have 10 months down. We are outperforming the S&P in that portfolio by 400. Wait, let me see if I have that right. 300, no, make that 371 basis points, 3.71% outperforming the S&P. And we do that by recommending no less than 5 or no more than 7 of the 11 spider sector ETFs like XLE, XLF, XLY, etc. Any one of those macro sectors that goes across consumer discretionary, technology, industrials, materials, etc. And what we try to do is avoid the underperformers. And unlike a portfolio manager who's benchmarked to the S&P, who usually has to have a pretty good representation of the S&P, we don't. So what we do is we try to avoid those sectors that on a medium-term basis look like they will underperform. So again, we are outperforming by 371 basis points with 2 months to go. This is for anybody who wants to be the S&P in a fairly simple way at a low cost. Secondly, for financial consultants who want to do this for their clients too, their goal is to beat the market as best they can. And this, again, really easy, low-cost way to do that. So you can sign up for that. It's $87 a month or less, depending upon how the period of time you sign up for and if you get any of our other products. So really low cost way to beat the S&P, and we are handily doing so. My email address, rick@inthenotrader.com. Keep those emails coming. I appreciate it. And I try to respond always within 24 hours and usually even less than that. Okie doke. Let's go to, so the trader education portion, we said we're going to talk about what to do when you have a cold streak as a trader. And all of us face that. It happens inevitably throughout your trading career that you're going to hit certain pockets of time where you just seem to not be able to do correct, and you take a string of losses, and it starts affecting how you feel about yourself. It definitely affects your psychology, your confidence, a whole slew of things that you start questioning should I be doing this, and how much more am I going to lose, and can I afford to lose, and da 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 da, and the mind just starts talking endlessly. Um, so these are a few things that you can do to try to break the streak of a string of losses in a row. It is definitely not a fully extensive list, but it is a few things that I think over my 40 years of trading I can pass on to you as helpful tools to try to cut down on the impact of what it's like when you go through a cold streak. So first off, and perhaps most importantly, is to take responsibility for the results you get. No one did this to you. Doesn't matter what happened in the market. Doesn't matter what headline came out to change the game. Um, and things do happen. But when you commit money to the markets, you and you alone are solely responsible for your results, regardless of any of the outside factors that influence why the market moves in the direction you thought it would, or opposite the direction that you thought it would. This is all on you. And the worst thing that you can do is start blaming other people or a CEO of a company for changing the game in the middle of your strategy, or a headline that comes out from Congress, or the government, or anything like that. It doesn't matter. You committed capital. You knew that there were certain risks when you did it. um, Things happen, and sometimes things don't play out the way you thought. So get off of the poor me type attitude, and this happened to me, and they did it to me, and the market did it to me. No, you did it to yourself because you took certain risk, and it just means that what you thought was going to happen didn't, and that's all. And it's nothing more than that. But take responsibility for the fact that you committed capital and you had the best of intentions, but it didn't work out. And that is, I think, from a psychological point of view, the most important thing you can do is just say, hey, no one did this to me. I took risk, didn't work out. Now let's, kind of think what we need to do past there. So one of the things you can do, observe what's not working. If you have, 5, 6, 7, 8, 9, 10 losses in a row, or a bunch of, if 3/4 of your trades are losses, um, step back, observe what's not working. What are you doing that's not working? Are you um, are you going against the grain? In other words, are you selling into what's generally a bull market? Are you buying into what is perhaps a bear market? Are you bottom fishing, or trying to, be a hero who can say, "Oh, I sold the all-time high"? Those rarely work out. So you have to have a process, and if your process isn't working, is it inherent to the models themselves? Is it just your timing is off? Is something else going on in your life that's not having you focus the way you should be? Are you focused and you feel like you're in the zone, and yet your trades aren't working out? You need to kind of figure out what's not working, because that is a very important step in trying to correct what's not working, is to identify first off what's not working. Um, so I think that it could come from writing in a journal. And I think, unless you're a top-notch trader, it's really a good idea to keep a journal of your trades. And I don't just mean where you bought and where you sold, but why you got into a trade, why you exited a trade. Is it working for you? Um, and thinking, and journaling this, because the other piece of why it's important to journal is to write down how you feel when you put a trade on, when you're in the trade, and when you exit the trade. Whether you exited the trade for a profit and you feel good, you can exit a trade for a profit and feel lousy. Yeah, that's really possible. Um, you can exit a trade for a loss and actually feel good about it. And it has to do with how you approach trading and how you realize this game is played. And you can easily take a loss and feel good about taking your loss. How is that possible? Well, let's say that you buy a stock at 30 bucks a share and you say to yourself, if it gets to, I don't know, 27.50, I'm out. And it slides to 27.50 and you get out. Um, and then it goes to 26 and 25. Well, I'm generally feeling good that I got out and was a disciplined trader and did and followed what I said I would do when I got into the trade. And it's really important that I think some people will argue with this. I think it's important to know where your target is when you get into a trade and where your stop out is. It doesn't have to be a stop out to the penny, but it has to be pretty darn close to, if it gets into this range, it stays there a day or two or whatever it is, you can define what that is when you first get in. But when it gets there, you either take profits or you take partial profits or you get out and you hit your stop. And consistently doing that will show you that you have the discipline to be a trader. There's plenty of times you're going to get out of a trade with a profit, and if you held on, it would have been more profit. I don't ever look back or care about that. If I set a target and I get out when I hit that target, there's a reason I'm getting out there. It's where I thought the stock or whatever it is I'm trading would have gotten there. And I had enough reason when I first put it on to think that that's where it's going to go, and it's going to have trouble once it gets past there, if it gets past there. So this is all part of the game of trading and being disciplined. Next, take a step back when you go through a cold streak. Um, the market's not going anywhere. It's open, I don't know, 250 or so days a year. You don't have to be playing every day. So if you go through a cold streak, take a step back. Not only do you want to observe what's not working, not only do you want to take responsibility for the things that didn't work, but it's not a bad idea to take a step back also and get recharged. And sometimes the best thing you can do is step away from the market for a few days and just like recenter yourself. And if the psychology piece of having a losing streak has gotten to you, the worst thing you can do is get right back in until you at least are much more at ease about that losses are just part of the trading game. And again, the market's not going away. It'll always be there. And therefore, you just kind of want to get regrounded before you start losing day after day after day and being in the wrong place to come back. So take a step back. Along those lines, cut down the size that you're trading until you've put together some winning smaller size trades. So if your normal size trade is a $2,500 position, cut it down to half of that and put a few winners behind you before you come back to your normal size trades. So it's a good idea when you go through a cold streak to cut your size down a bit. Your goal when you go through cold streak is not to make your money back in the next 5 trades. That is revenge trading. It is the worst thing to do. If you have a process and a way that you trade that you've proven to yourself works over time, when you go through the inevitable cold streak, your job is not to make all that money back in a week. It's to get it back over time by doing the right things, trading the right way, and doing the things that it takes such that you keep your losses small. And by cutting down your size trade, you will hopefully, if you lose, you will lose less than you had on when you were going through the cold streak. So it's possible your cold streak even continues. But now, while you're refining and observing and doing the things you need to help improve what's going on, one of the ways you do that is by cutting down on the size trade. until you start putting some winning trades together and start feeling better again about what you're doing. Another thing is, and this takes a more enlightened person to be able to think this way, but your losses can actually inspire you. So you can actually feel, and again, think about one of the words I'm saying here. You can kind of become inspired by a string of losses. And that's because it'll make you re-look at what you've been doing with the goal of improving what's not working. And if you can improve what's not working, whether it's in trading or in your life, in a general sense, right? If pieces of your life aren't working for you, well, then take a step back, observe, and figure out what you need to do to change that. So you can get inspiration from losses, and the inspiration is to improve, to get better. So it's not always the worst thing in the world to go through a string of losses. It will help you be a better trader over time. And then remember that you're not defined by your trading. As a person, you are a holistic being. Trading is, and even if you are a professional trader, it is just one piece of your entire life. If you go through a cold streak, it doesn't mean every facet of your life is on a downturn too. And by the odd chance that everything is not going right, take a step back, observe what's not working, go through the same process, get inspired by it, because it'll help you improve who you are, whether it's as a trader or as a person in general. So those are a few things. And look, there's books on trading psychology. There's probably a ton of stuff on the web you can find about, how to handle a string of losses. This is just a few things that over the years I think about when and if I go through, a slew of bad trades where, I just keep losing money and the things that I'm doing are not working. So hopefully that's some help for you. Before we get to our individual charts, there was one more here. Come back to normal size trades. Yeah, eventually, as you start putting some winners back into your books, you'll feel more comfortable, and eventually you'll go from the smaller size trades to your normal size trades, and you'll get back with improved process, improved psychology, improved observation of how to make things work better, so that you back into your, let's call it, normal trading routine. Okay. Let's take a look at just the macro sectors of the market as we shift gears here. S&P up 16.77%, not including today. We've got a down day in the market. Energy still the big winner of the year. As far as I'm concerned, it will be for the second half of the year too. It will still be the far and away big winner of the year. So it may not be at 47% versus where the S&P is, but it will be the large winner of the year as far as I'm concerned. Financials and real estate kind of playing neck and neck, along with communication services for the next few places, and then most other things are kind of similar to where the S&P is, except for staples and utilities, which are badly lagging. And unless the market takes a significant dive, I'd expect that to stay that way with those two significant underperformers. Okay, let's go to charts. So we're going to start off, we said macro, we're going to take a look at the XLE, XOP, we're going to concentrate on the energy sector. So here's the, this crude oil, we'll get to that in a second. Let's start with the XLE. Here we go. So here's the XLE on a weekly chart. This green downtrend line comes from all-time highs back in, I don't know, maybe 2014 or something like that, I think was about that time. But let's blow up the chart here and see what we've got. We're still just about holding on to these two trend lines, whether it's the magenta colored one or the navy blue one off of the fourth quarter low in 2020. You can see just based on today's actions, looks like we're just potentially tucking underneath. Notice that we had in February upside exhaustion signals on the same week. 13 bar, that's the sequential model from Tom DeMark. The 9 count is the setup count, part of the sequential model from Tom DeMark. The market ultimately went right to the risk level here at 55 and change. And it's again, potentially breaking these lines. If we came back down, and this is on a percentage basis, it's quite a distance away. If we were to get down towards 42.5, I'll highlight it here. That is where the bearish propulsion level kicks in. My guess is that that will not get properly broken, such that that is likely a place in the future if we get a decent correction. Even if you get to the mid 40s, I kind of think you'd want to be a buyer of XLE, and in general, I guess, energy names on a pullback like that. Upside targets are on either side of 60. You'll see these two levels here. Those are kind of further upside targets if we keep going higher, as well as the downtrend line from all-time highs. All right, XOP, the actual oil and gas ETF. Let's see, do I have it here? No, so we'll switch to it. Here's XOP. So you can see it's running into resistance against some of these highs here from 2019, early 2020. Let's take a look if we put up a trend line, how we are doing. So this stronger than the XLE technically, in the sense that we're not breaking underneath this line yet, whereas the XLE was. So the XOP is a little stronger. You did have a pullback from this 13-9 combination. You're possibly pulling back a little bit here from this 9 setup count. Again, for those who are new to this, when you get a string of Friday closes, or any time frame that you're looking at, this happens to be a weekly chart, so we're looking at weekly bars, 9 consecutive weeks that the closing price closes above the close from 4 Fridays prior, or 9 consecutive weeks that you close beneath the close from 4 Fridays prior, you often have a potential turning point. Doesn't have to be a major turning point that lasts for 6 months. Could be last for a few weeks or a month or two, like this did. But we're getting it again. Upside, you can see as big a move as, so you've got about almost, let's say, 10% upside versus about 10% downside here. So you're kind of in the middle. The trend is your friend still. So in general, you'd be more looking to be a buyer than a seller. But these, we use these models to help identify turning points in the market. And at least right now, that's what we're seeing. We have not gotten a qualified and confirmed propulsion breakout to the upside yet. So we'll have to wait for that. Last thing we'll take a look at is just crude oil. And last night, crude oil traded up to $76.98. It's now trading $73.60. So we are full $3.40 or so off of the high. Big reversal on the OPEC news. Notice that today's high is virtually the same high from late 2018 when oil got to 76.90. Today's high is 76.98. So we know that there's going to be some natural resistance somewhere up here. We're on a 12 count towards a 13. There is significant support just beneath $60. That is where I would expect oil to hold on any decline that we'd see now over the near term. All right, let's get into the actual names that are part of the oil and gas index. Marathon Oil is actually the heaviest weighted name. Interesting. Well, at some point here, we'll get to Exxon. Normally, Exxon you'd see as the biggest name in any type of oil index, but it's not in this particular index. So Marathon, MRO, is the first stock we'll take a look at. 13s and 9s on the bottom, 9 count year, also earlier in 2020. Same, similar look. 9 count pulled back earlier this year, 9 count again now. So this looks very similar to the XOP, which makes sense. It's the biggest name in the XOP. So initial support near 1260. More important, if we got to pull back to 1075-ish, 1087. So let's just call it round numbers 11 to 1075. Probably a good chance you're going to see support there. If we saw a bigger decline right now, $9 is 903 is the place. It'd be what we call a two-handed buyer. In other words, a significant buyer. But my guess is we're not going to get much lower than 11 to 1075 on any type pullback. On the upside, first target higher is 1484, then 1667. Okay, FANG. Diamondback Energy. Don't confuse this with the FANG stocks. There's a ticker in the energy space that is FANG, and it's Diamondback. So same thing, sequential 13 signal last week. Aggressive sequential signal came a little earlier. So certainly I'd expect to pull back here at least down to 89 and change. It's currently 92 and change, so I'd expect some more to go. Secondary support from the clouds baseline right now at 78.30, and then big support down at 71. That's, percentage wise, a good chunk of this year's up move would dissipate if we got all the way down to 71. But as of right now, if for whatever reason we got down there, that's where I'm a big buyer. Next, Devon Energy, DVN. Devon, notice, does not have the 9 counts or the same type signals we have on top, but notice just here, 13 bottom, trend change, 9 high, trend change, 9 high, 2-month or 3-month trend change into a 9 down trend change. This 9 down led to this 13 bigger trend change for this whole move up since then. So we have a propulsion exhaustion signal that was hit a little over a month ago. You can see by and large this has climbed up the baseline, the conversion line rather, of the cloud model. So holding first level support right now, secondary support 24-ish, third level 21.5, where I'd be a significant buyer. Valero. Similar looking charts, lots of turns on 9s. That's why we like them. Pull back here, look for about 70-ish first support, 62 at 62.25 or so second support. Pioneer Resources, no exhaustion signal here on the upside, but if we pull back, look for 145 first support, 134-ish second more significant support. Oxy Petroleum, OXY. Double 9 counts like some of the other XOP names. So look for some pullback on the upside. If we follow through, look for 34.5-ish is the first upside target. MPC, Marathon Petroleum, different than Marathon Oil. Trading 59, look for first support 53.5. And we've got time for 1 or 2 more. Exxon. Same thing, climbed up the line, the pink line here, the conversion line. If we fall, 54.5-ish, give or take. Next support beneath that, 50 and change. And let's finish up with APA. Stop right at the propulsion exhaustion level, pulling back here. First support, 19, the low 19s. More important, down at 1275, again, percentage basis, that's huge. I doubt we would see that. So I'm still looking to be a buyer on these pullbacks here in the energy space. I do think we've got a decent bottom in. That's it for this week's show. I hope you enjoyed it. I am Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.